Let's now turn to endowment investing, and that lessons perhaps for the private wealth market. Daniel Kelly joins us from Viola Private Wealth. Daniel, welcome. Good to catch up with you again. So endowment, the endowment model. Now this was pioneered by those Ivy League universities in the States, principally at Yale. But look, I mean, essentially this is about minimising risk, optimising returns. I mean, surely any investor should be trying to do that.
Yeah, it's not rocket science, right? Like that's the name of the game: increase returns, and not at the cost of marginal risk. So it was Mr. Swanson at Yale that really pioneered this model, and it's something we're thinking quite deeply about at Viola, about lessons that we can take to the private wealth market. And I think that it's been a very successful form of investing for a long period of time, which is characterized by higher than probably typical allocations to private markets, and that's allowed Yale and Harvard, which are the two notable institutions that have used this model for the last few decades, to produce, low double-digit returns, which it's been a compounding machine for these institutions over the last 20 years. It's now accessible for individuals and families to replicate a similar model, and that's primarily because of the democratization of alternative investments and the access point, being reduced from, $5 million minimum ticket sizes into some of these funds down to more palatable sizes of 100,000 or 200,000 that the most high net worth or ultra high net worth clients can stomach.
Daniel, can you give us some examples then of practically how you're actually employing this strategy?
Yeah, so I think what I was saying before about the access point, really being innovated over the last 5 years, I would say there's a lot of semi-liquid vehicles that are being created by some of the best asset management firms in the world that are taking, what traditionally you would have needed to lock up money for 5, 10, 15 years into some of these structures to access the illiquidity premiums and alpha generation potential, that the asymmetry that in private markets kind of allows you to access. You can now get that in a semi-liquid vehicle structure. We always take the liquidity with those types of vehicles with a grain of salt, because we understand that, for something like venture capital or private equity or private credit, these are inherently illiquid, securities that they're investing into. And so we build that into a portfolio construction approach. But I think we talked about this on a previous episode. We have something called the core squared satellite model that we're rolling out to our clients, which has probably a higher allocation to alternatives than most other groups out there. We think that actually a lot of groups are practicing this. It's just that what they say they're doing versus what actually ends up in a client portfolio can sometimes be quite different. And that would be characterized between, say 20, 30, 40% allocation to alternative investments, still done in quite a liquid, holistic portfolio structure. And we think that will allow us to kind of generate between 200 to 400 basis points of additional return for clients.
So Daniel, can you give us a sense then of those alternatives that you're actually investing in?
Yeah, so the primary categories would be private debt. So we categorize private debt and private credit separately. Private debt for us is real estate-backed private lending, which is what most Australians are familiar with. Private credit is, lending to corporations, primarily mid-market, strong cash flow positive corporations. And we use domestic and international exposures. So private debt, private credit, hedge funds, real estate, private equity, and venture capital would be the primary asset classes. And so we use the CFA definition of asset classes, whereby traditional asset classes are long only, stocks, bonds, and cash. And then alternative investments are all of the other private market opportunities. And that's the same definition that Harvard and Yale and all the main US endowments use.
And how are those interest rate movements, or at least the trajectory, likely to influence your investments at this point?
We take a very long-term investment horizon. And so whether a client that's in front of us is 30 years old or whether they're 80 years old, if you're 30, you've got most of your life before you, and you need to be investing with a 50 or 60-year time horizon. That's how you need to be thinking about, portfolio construction. And if you're 70 or 80 and you don't have as much of your life before you, you're still investing for the next generation, right? So we take a very long-term approach to our strategic asset allocation. So we think that, short-term interest rate movements doesn't really have too much of an impact on our portfolio construction, because long-term average rates, it doesn't matter whether the RBA cuts now or next month, the long-term discount rate is still relatively unaffected, which obviously is what's used in the DCF to get current asset prices. So short-term noise and volatility movement, we might use that to take advantage of access points and entry points into markets. It primarily moves listed equities and fixed income. The alternative investment sleeve is relatively unaffected by these things. We get quite a lot of exposure to floating rate kind of investments through our private credit and private debt exposures. And so whether we're going through an interest rate rising cycle or a cutting cycle, the duration effect is relatively limited for those allocations.